I want to start off with this chart that kind of illustrates the mood that we're seeing when it comes to equities trading at the moment, right? We're seeing, bulls still kind of trying to set up new highs. Just a couple of sessions ago, we were within 1.8% of a fresh high for the S&P 500. But we're looking at this kind of range-bound back and forth session at the moment. Is this just the fact that we're seeing the old playbook of avoiding the growth-sensitive stocks, avoiding growth-sensitive currencies, buying bonds, and at the end of it, we're at the end of this cycle?
Well, I do think, Heidi, that you're absolutely right, that markets have been range-bound. And to us, really, that's one of the four factors that make us bullish and look for a risk asset rally this fall. So one is that markets have chopped a lot of wood, been a lot of negative issues in the last couple months, seasonally the weakest time of the year, and that equities are only 1 or 2% off over the last 3 months, bonds up 1 or 2%. So that's one. The second is we believe global growth is bottoming. If you look at the manufacturing PMIs, they've started to bottom. They've been up for the last 2 months. And autos and semiconductors, two main parts of the industrial complex, are also trending up. So that's our second factor. Our third factor is that we believe geopolitics are finally stabilizing, right? This has been an overhang of uncertainty for markets all year, and yet I believe we're at the point where everybody needs a win. President Trump can use a win. President Xi can use a win. In Brexit, Boris Johnson can use a win. In the EU can use a win. And in fourth, and most importantly, the policy mix has changed very much for the better. And in our own work, we call the global risk nexus. We've noticed that policy over the last 12 months, where we are today in policy versus a year ago, because a lot of people were talking about how Q4 would be the same as last year's devastating Q4. But for us, policy is actually much better placed today than it was a year ago. And our outlook for economic growth over the next 6 to 12 months, likewise, has really turned up. So for us, we're positive, and we think risk assets will rally as we go through the course of the fall.